In this YouTube video, we will be discussing the basics of bonds, including different types of bonds, associated risks and returns, and investment strategies. We will cover government bonds, corporate bonds, municipal bonds, and zero-coupon bonds, as well as discuss diversification and bond fund investing. By the end of this video, you will have a better understanding of bonds and how they can be used to diversify your investment portfolio. Hello everyone, my name is Charles and welcome to this YouTube video about understanding bonds. In this video, we'll be discussing the basics of bonds and how they work. We'll also explore different types of bonds and their associated risks and returns. By the end of this video, you will have a good understanding of bonds and how they can be used to diversify your investment portfolio. Let's get started. Definition of bonds. A bond is a form of debt security in which the borrower agrees to pay back the lender, or bondholder, a certain amount of money over a fixed period of time. The borrower typically pays a fixed interest rate over the life of the bond, which is known as the coupon rate. Types of bonds. There are many different types of bonds, including government bonds, corporate bonds, municipal bonds, and zero-coupon bonds. Government bonds are issued by national governments and are typically considered to be the safest form of bond investments due to the backing of the government. Corporate bonds are issued by companies and have varying levels of risk depending on the creditworthiness of the issuing company. Municipal bonds are issued by local governments and are typically tax-exempt, meaning that the interest payments are not subject to federal income tax. Lastly, zero-coupon bonds are bonds that do not pay periodic interest, but rather are sold at a discounted rate and the face value is paid back at maturity. Risks and returns. As with any investment, bonds come with associated risks and returns. The risk associated with a bond depends on the creditworthiness of the issuer, the maturity date of the bond, and the current market conditions. Generally, bonds with shorter maturities tend to have lower risk but also lower returns, while bonds with longer maturities tend to have higher risk but also higher returns. Investment strategies. When investing in bonds, it is important to have an investment strategy. Generally, investors will look to diversify their bond portfolio by investing in bonds of different maturities, issuers, and risk profiles. This allows investors to spread out their risk and potentially maximize their returns. Additionally, investors may choose to invest in bond funds, which are collections of bonds that are managed by professional fund managers. Conclusion. In conclusion, bonds are an important part of any investor's portfolio and can be used to diversify their investments and potentially maximize returns. Understanding the different types of bonds, the associated risks and returns, and the various investment strategies is key to successful bond investing. Thank you for watching this video about understanding bonds. This video was brought to you by Channel Success Mindset and Personal Growth. Subscribe now and start your journey towards success.